Hello, everyone, and welcome back to the next session of TXF Global Trade Virtual 2021. My name is Heshem Zakai. I'm the Managing Director of TXF, and I'm delighted to be the moderator for this next session called the Growing Trade Finance Gap, SME or Bust. In recent years, the trade finance gap has yawned particularly wide, reaching $1.5 trillion according to the most recent report from the ADB. Moreover, this $1.5 trillion disproportionately impacts SMEs. Now you take this environment and you overlay it with the pandemic, and it's very clear to see some of the challenges that SMEs are currently facing. So what exactly does the macro picture look like today? How did we get here? What are the steps being taken to try to get out of it? And what more needs to be done to try to facilitate SMEs' access to finance in a way in which they fully understand and are able to make use of? These are some key questions, so in order to answer them, I'm delighted we have some key panelists. I'll introduce them to you now. Firstly, we have Mr. Todd Burwell. Todd is the President and CEO of BAFT, which this year is celebrating its 100th centenary anniversary. Many congratulations on that, by the way, Todd.
Thank you. Thank you. Happy birthday to us.
Indeed. And I'm going to try to get the chaps to do a rendition of Happy Birthday at the end, so make sure you stick around for that. Next, we have Oswald Kuyler. Oswald is the Managing Director, DSI, Digital Standards Initiative at the International Chamber of Commerce. I did take a quick look, and the ICC was founded in 1919, which I think makes you 2 years older than BAFT. So you can have the special seniority award on this panel, Oswald. But great to have you and welcome.
Thank you so much. Absolute pleasure to be here, and happy birthday, Todd.
Yeah, I should probably point out for the viewers, it's BAFT rather than Todd that's reached the centenary, though the experience, I'm sure, is equal and parallel. And very finally, we have Tom James as well. Tom is the CEO, CIO, and co-founder of TradeFlow Capital Management, I should say, which was established in 2016. So a bit more sprightly, Tom, and hopefully you'll be bringing some of the innovation and new ideas to the scene as well. Pleasure to have you.
Thank you very much. Yes, great to be here today. Thank you.
Super. So gentlemen, let's get started. And I think the best way to do this, and for the benefit of the audience, is if we begin with a really macro picture and then drill into the detail as we progress through the panel. So Todd, I'd like to ask you to maybe help us set the scene a little bit, the broad landscape as it currently stands today in terms of financing, in terms of trade finance, and particularly for SMEs.
Sure. So I think the challenge that we have is one that existed pre-COVID, and there are certain elements of the pandemic that have perhaps accelerated or exacerbated some of the challenges. So, I mean, this $1.5 trillion trade gap has existed for several years now, and as we've looked into it, there's a component of it that's really driven by the access to credit and perhaps in some cases the credit worthiness of SMEs. But there's another component that was really a growing concern, which was just the ability of financial institutions to bank SMEs given some of the KYC concerns and requirements and things of that nature. But I would say if you go up a level, and let's just put the financing aside and you think about challenges to SMEs broadly, you've got, generally speaking, whatever the business conditions are, the economic conditions, oftentimes are going to be more severe for SMEs. You've also got more challenges with cash flow, in many cases insufficient cash flow and reserves for SMEs. You've got recruitment challenges when it comes to getting the staff and the personnel and expertise that you need. And then you've also got the access to the finance. So when you think about the pandemic was a combination of a massive demand shock, a supply shock, depending on what business you were in, that supply may have just completely shut down. And then you also had a labor shock. In some cases, because of lockdowns, people could not go to work. And so the ironic thing is that during the pandemic, perhaps the one thing that did have a positive trend was access to finance. And a lot of that is because of what many of the central banks and governments and development banks around the world did. Unlike 2008, this was a health crisis that led to a financial crisis. And the concern of the central banks and development banks was to not let this become a credit crisis or a capital crisis. And so virtually everyone around the world stepped in with some sort of a stimulus to provide liquidity, to provide credit relief, debt forgiveness, or in some cases to directly fund initiatives. So I think that governments do deserve, in many cases, a lot of credit for trying to specifically help SMEs through this past 18 months or so.
Fantastic. Thank you very much for that. And I want to kind of latch on to one of the points you made about some of the actions that governments took. Of course, this being a global event with participants from all over the world, you won't have time to focus on every program from every government across the across the globe. But even if we take, for example, the United States, would you say that the programs were targeted in such a way that they fully enfranchised and included SMEs, that they were a big part of what governments have been trying to do and have been successful at doing?
Yeah, so I think in the US and in other countries, there's been a few areas that governments have targeted. Certainly just in terms of getting PPE and getting certain healthcare and access to machines and things like that was one path. But in many cases, there was direct relief that were offered to individuals and consumers. That, I think, went towards the issue of people not being able to work as a function of lockdowns. And then to specifically target businesses, I think there were programs that were able to provide credit. Specifically in the US, there was a paycheck protection program, which was about over $500 billion specifically just for the paycheck protection program. And then I think there was encouragement to financial institutions to allow for a little bit more leniency in terms of debt repayments and things like that. So very clearly, one of the concerns was, how do we keep SMEs afloat? Now, what was interesting is if you look at, so did that work? When I actually did some research, if you look across various countries, the bankruptcy percentage during the period of the pandemic, in many cases, went down. And in some countries, it's actually the lowest that it's been in 20 or 30 years, which in many cases, it made no intuitive sense to me. But at the same time, you also saw business closures at a much higher level than they had been. So specifically in the US, I think there were about 200,000 more business closures than usual. And so I think, again, with SMEs, you had the case of some SMEs that were able to tap into these programs and get the liquidity relief have been able to sustain themselves. But there are still those that just did not have access to those programs or weren't able to do it quickly enough and have fully closed.
Yeah, brilliant. And I mean, there's another interesting point in there that you made as well about this being a health crisis rather than a financial crisis. Now, when introducing this panel, of course, I talked about BAFT's storied history. And I know that BAFT will have been active, during the 2008-2009 financial crisis. Do you think that many lessons were learned from there that we actually saw implemented this time around by the financial sector? And moreover, do you think that this, the kind of response, which in some cases really has been kind of very speedy and very effective by the financial sector, represents like something of a triumph when you kind of set it against 2008, 2009?
Yeah, so it's interesting. The first thing that I heard from many of the banks, as well as many of the policymakers, was the key difference between the pandemic and the financial crisis is that banks did not cause this crisis. So in one way, we had the opportunity as an industry to really be seen as the kind of the white knights in that regard, because banks could actually help companies and help people through this crisis, and we weren't necessarily the cause of the crisis. That being said, it was very clear that some of the work that the industry has done to better capitalize itself, to create better risk management capabilities, to advance certain digital initiatives between 2008 and 2020, I think really helped the industry to be able to deploy liquidity much more quickly, to be able to manage it more effectively and have controls in place. So I don't think we are fully out of the woods yet, but I think there are clearly some lessons that were learned from 2008 that helped us prepare.
Fantastic. Thank you very much, Todd. I'd like, if I may, to turn to you now, Oswald. One of the salient points that Todd made was that a lot of the environment that we talk about, it's not a COVID environment, it's not a pandemic environment, it's something that predates the pandemic, and then the pandemic shifted it in one particular direction or another. And I suppose when the ICC is thinking about some of the companies that it's trying to help, and if we put in the context of this panel, and we're looking at SMEs in particular, for sure, it can be said that SMEs and suppliers had pre-existing challenges that then met a different kind of complexion when the pandemic hit.
Yeah, there's quite a few numbers that's been released over the last, let's say 12 months. The first is the trade finance gap, and Todd also mentioned that. The second one is the ICC released a study that we did, I think it was late last year, that showed for us to get back to pre-COVID levels, we need anywhere between $1.9 and $5 trillion of additional liquidity, in addition to the actual trade finance gap that has been well documented. And more recently, you would have seen we released an additional study through our research group in the beginning of this year that highlighted if we don't actually help vaccinate some of the developed nations where a lot of our supply chains originate from, we are looking at an additional $9 trillion being impacted. Now, these numbers sound really massive, and I think at times it's very hard to comprehend what they actually mean. And so when you break it down, it fundamentally means three different groups of people are being impacted. The first is companies themselves. That number represents growth being hindered, opportunities being lost. It impacts the actual employees from a job security perspective. And finally, governments from a revenue collection perspective, which is going to be very important going forward to assist in some of the activities they did. Now, when you break it down to the actual individual stories, which is where I think it becomes easier to understand what that number is, I just think about, for example, the last week alone, I've spoken to someone who owns a restaurant, someone who owns a gym, and I've seen some of the activities in the commodity sector. And if you think about the people who own, that person who owns the gym and the restaurant, the reality is their balance sheets have been impacted. They are no longer as strong as they were pre-COVID. And if they struggled to get access to finance pre-COVID, the challenges are so much greater now, especially as some of the assistance from governments are starting to run out, if you will. And then you look at, for example, on the commodity side, where they've seen that, look, there's an impact on some of our smaller suppliers. And more recently, I think it was last week, we saw companies even like BHP adjust payment terms and say, you know what, if we're going to be resilient, we need to ensure that we go from 60 days to 7 days so that I can actually help our suppliers. So I think to summarize it all, an enormous impact, and that impacts entrepreneurs. And if you think about the SME go bust, it fundamentally means that there is a whole bunch of people who either need liquidity to continue to grow or have gone bust. And these are entrepreneurs, these are creative people who are going to create the next company. How do we ensure that they can get access to capital and that this doesn't hold them back? So I think we have quite a bit of work to do. And that's putting it lightly.
No, that is, and what a startling figure: $1.9 to $5 trillion needed just to try to get back to the pre-pandemic levels. I do have a couple more questions for you, Oswald. I'm just going to give Tom a bit of advance notice that you know, during the course of this next couple of questions, he needs to try to find at least a couple $1 trillion. So hopefully somewhere in the sofa or behind that desk, you'll be able to find a bit. But you've got 2 questions worth to find it. In the meantime, though, Oswald, I think the point about the robustness of supply chains is a really fundamental one. Supply chain finance as an architecture was always intended to be something which protected smaller suppliers, but also to protect the supply chain as a whole. So the bigger buyers would have a robust source of supply in times of need. How would you appraise how it worked during this kind of, this time of stress, this time of effectively crisis? Would you say that the payment terms had been extended too far beforehand, and therefore it wasn't in an optimal position? Or would you say that actually, it held up robustly well given the extraordinary circumstances?
So I think it's quite a difficult question because multiple different industries approached it slightly different ways. I think before the pandemic, we definitely saw the age of productivity. So we saw a lot of people optimize working capital positions, et cetera. And I think that was needed. It was needed to optimize margin and compete and all of the activities that were required in that space. If you have a look at what some companies have done during the pandemic, we've seen companies increase hiring practices in different countries where they've actually recognized that in order for them to succeed, they needed to ensure that some of the job losses in different countries were actually cushioned. And so we've seen some of those activities, we've seen companies help suppliers, and we've seen new innovative solutions come into place so that companies can actually offer and extend credit into their supply chains and actually help some of those smaller suppliers. Now, I want to extend that a little bit to some of the insight that we got out of the Asia Development Bank's report on that actual gap, on the problem, on the big, how do I get access to capital, regardless as to what the big company is doing. And when you think about that number, and we think about the businesses trying to get access to finance, only about 20%, in fact, it was 20% that was registered in that report as being, and don't quote me, but bad deals, right? And so there's a portion there that we go, okay, this is probably something pre-COVID or post-COVID or during COVID, you probably wouldn't have been able to do something about it. That being said, if you look at some of the other numbers, so if you look at, I think it was something like 20% where it was just KYC concerns. If you think about, I think it was 19% where it's like, we need more information. And so what we've seen during COVID is we've seen a lot of innovative companies come forward and say, you know what, we can actually help solve some of these inefficiencies. We've seen companies like, I'll just pick one, Montego come in and say, we can actually reduce KYC costs and we can do that differently. And we've seen some other solutions like Tom's come in and say, you know what, instead of just trying to digitize the process, how about that's the secondary objective? The primary objective is how do we give people access to liquidity? And the secondary objective is we'll take care of the paperwork and the actual digitization of the trade. So I think it's new businesses have formed. They've helped the supply chain stay afloat in addition to some of the activities the larger organizations have done.
Brilliant. Thank you very much. A really comprehensive answer. And you mentioned there some of the solutions that companies such as Tom's are trying to provide. So a perfect segue to introduce Tom. And actually, maybe Tom, I could just ask you, because people won't be quite as familiar with TradeFlow Capital Management, though increasingly so, maybe you can just talk to us very briefly to begin about your model.
Yeah, certainly. Thanks. So basically, TradeFlow, me and my co-founder, John Collis, we started this journey back in 2016, basically looking at the increasing problem for SMEs in particular in the bulk commodity space. So these are, the lifeblood of economies. This is food, fuel, metals, etc. Stuff that needs to move around to help industry work. And what was happening really was, when we looked at it, it wasn't a problem that was going to go away. That was the first question. Is this just a blip? Is it going to get better? And it's only got worse. And so, as Todd said, this was very much a pre-COVID issue. And so we looked at why SMEs could not get the traditional trade finance for import-exports of bulk commodities that they needed. Banks want to lend money, but the fact is costs and also how capital is treated, also the benefits of owning commodities on your balance sheet as a bank has just become less and less, and with Basel III and in a few years Basel IV, etc. So, it's become increasingly tough for a bank to get credit risk mitigation benefits of owning whatever is being transited and moved around the world. So we looked long and hard at this, and so how to solve this issue. The background of our team is very much from commodity trading, risk management, shipping, IT. So we kind of took a holistic approach and built what is now the TradeFlow Fund and the TradeFlow Solution, where our fund steps in the middle between suppliers and buyers as a true owner, as a neutral principal. We take risk, market risk, etc. We own the commodity during shipment, during storage. And this means that we're able to enable trade, not only for SMEs who can't get enough traditional trade finance, but for those who have the expertise, but maybe have just set up a new company and don't have the 2-3 years of audited track record that is often a prerequisite for your traditional credit lending type approach. And so, we kicked off our fund, finally going through this building the business model. We could see that the only way to do this on scale was digitisation. So we interlink a lot with ICC and Oswald's DSI, Digital Standards Initiative, because we can only do this globally and on scale if we digitise. As a neutral principle, we have to handle bills of lading, insurance documents, contracts, port contracts, etc., lots of stuff. And so we now have been doing this for 3 years. We've helped about $600 million of trade. That doesn't sound like much, but most of the deals that we enable are, around $600,000, $500,000. So that's quite a lot. And we have a footprint from South America across Africa and Asia. And what's really nice about it is that coming into COVID and the difficulties there, we were able to continue to operate. So whereas it became very difficult to price credit in some developing countries, etc., in particular, we were able to continue to operate because we don't lend money. We invest in and we own that commodity, whether it's a bulk cargo of rice or diesel or whatever, and get it from A to B. And the nice thing about it is that we're collaborative with banks. And so because we don't lend money, we work with a lot of banks. They introduce their SMEs to us, who they say, hey, these guys are good. They've got a great, they've got good careers, good track record. They're not big enough yet for us to cost effectively lend or support them yet. And so that's where we pick up and help develop the SMEs. And after 3 years, we have several companies who now have grown globally and are now getting traditional trade finance. So we see ourselves very much as an incubator and a collaborator, fitting neatly into this gap where it's difficult for banks to cost effectively lend at the moment.
Yeah, and that's a really interesting dynamic there, whereby you have the banks bringing clients to you in the first instance, and the banks saying, unfortunately, we're not able to service these guys, at least not in this way, but it's maybe something you can do. You do that for 2 to 3 years, and almost kind of like pass them back or refer them back to the banks, by which point they are able to work with them. So a really nice symbiosis there. I guess maybe the easiest question you will get is, what has been the impact of COVID in terms of the demand that you have seen from some of these SMEs and some of the referrals? Because one would presume it will have gone up, but maybe you can kind of color that picture in for us a little.
Well, Heshem, it's a very good question. I mean, we've been doubling our assets under management every year since we launched. Despite that, before COVID, we had 10 times more business without any real active marketing for originating customers or transactions, 10 times more business than we had money. And certainly post-COVID, I would say that's about 30 times. Wow. Without any real additional effort on our part. So, I mean, we're talking about, we have pre-vetted, billions of dollars worth of turnover. We've actually onboarded over 800 SMEs around the world. And in fact, that's thanks to digitization. So, when we spoke to banks back in 2016, when we researched the problem, a lot of the issue is lack of data, but also the cost of KYC AML. Yeah. And so we have a digital online system that does that. And because we're the neutral principal in the trade, it means we get all the data before the deal happens. So, again, digitizing data, we have AI systems taking in bills of lading information. And so, as we build more and more data, that helps us do our business more effectively. So, yeah, very, very exciting times there.
Fantastic. Thank you very much. I'm going to go back to you, Oswald, because a lot of what we have heard from Tom, he's touched on some of the challenges, he's touched on the importance of digitization and also the ecosystem. The stat varies, depending on the research paper, I suppose, but I did read that typically there's 30 parties, 40 documents, 200 different kind of junctures within kind of one supply chain route. So it's an extraordinary amount. And I know that this is something the ICC has been trying to work on and very recently launched a very interesting initiative full of kind of products and services, ICC Trade Now. Great opportunity for our audience and for us here to hear a little bit more about that, and crucially, how you think it's going to address this gap.
Yeah, thank you for that. I think there's a few things there, and I'll just touch on three things briefly. The first is when we look at the trade financing gap and we have a look at if we take a macro level view, on the right-hand side, you have liquidity in different organizations. So you have multilateral banks, treasury departments at organizations, family offices, etc. And a lot of that is, some of them are actually focused on how do I save my supply chain, or how do I uplift people out of poverty. And on the other side, what we have is multiple new organizations that are actually trying to get that liquidity to SMEs so that they can actually continue their business. And what we found the inefficiency is really in the middle, is how do you actually bring these two groups together so you can actually make an impact? How do you help that treasury department who's trying to save the suppliers within their supply chain actually do that using either new technology or using modern new business cases like the one that Tom just suggested? The second element there is also educational. When we think about the ADB report again, it also highlighted that there was multiple different avenues to get access to financing, whether it is invoice financing, P2P, etc. And one of the data points that really stood out was that a lot of SMEs didn't know it existed and that it was underutilized. So in addition to getting the liquidity to the SMEs, how do you actually enable them to understand these are the locations you can go to do it? And so there's an educational component there. So our Trade Now campaign is all about how do we do that? How do we take our superpowers of bringing people together in alignment with our purpose and actually make a dent in this trade financing gap?
Fantastic. Thank you very much. Just before I move on, just a quick reminder to our audience, because this is being broadcast live, we're able to take your questions and answer them as well. You will see that there's a submit question button just below the chat box. Please click on that and post any questions you have, and we'll be sure to address them to the audience. Todd, I want to come on to you, and as we kind of get towards the end of the session, almost in the way, fingers crossed, we get towards hopefully the back end of the pandemic or its worst effects. It's important to remember, isn't it, that not every country and not every economy will emerge from this in the same way and at the same time and with the same implications. So could you talk to us a little bit about how you might see that from a macro level happening and what some of the potential ramifications could be?
Yeah, so it's interesting, and I can localize this to what I go through in just personal conversations I have with people I know that live in different parts of the U.S. But I think it applies on a global basis as well, which is managing through this pandemic has been trying to find the right balance of the approach to the health crisis itself, because that's really the core of this. And until you solve for that, then everything else that happens economically is going to be constrained by the health crisis. But there's a balance, right? And there are those that want to open everything up because the remedy in some cases of shutting everything down creates an economic pain for people and for small businesses that could lead the businesses to close. That could lead people to, no longer be able to provide food. So you have this push-pull between dealing with the health crisis and dealing with the economic fallout of it. So there was actually an index that I remember reading that was, it might have been Bloomberg, where they looked at sort of the combination of how countries dealt with the health component as well as the economic component and came up with an index. My observations were that the countries that had dealt with the health crisis the best tended to score the best in this index because they didn't necessarily have to do extreme measures from an economic point of view. So there's less, to bear from the standpoint of sovereign debt or stress on credit and so forth. So if you think of places like New Zealand, Australia, South Korea, Israel, some of those types of places that have done better than many others, they also perhaps had less stress on their sovereign debt and things of that nature. So as we kind of look at the government response to some of these packages, there were many economies that were able to throw a significant amount of financial relief against this effort. And in some cases, you saw 10, 15% of GDP that was being contributed to pandemic relief. Well, at some point in time, that bill is going to have to get paid. So I think one of the things we have to watch towards the tail end of this pandemic is the amount of sovereign debt that countries are carrying as a result of pandemic relief. And then if you look at individual financial institutions, I think this becomes a question of credit capacity. So when they start to normalize business relationships again, where are they in their credit capacity to lend to existing customers, to lend to new customers, and where does that balance sheet usage go? So, organizations like Tom's, I'm sure is going to have a line going down the block and around the corner because the demand for capital is going to continue to be great.
Brilliant, thank you. And I would like to bring you in on that point, Tom, to comment on that. And the question around, who you see providing a bit more of this capacity as well. I know you work with all sorts of institutions, and you've already commented on your work with banks, but indeed your portfolio is wider than that. So it'd be great to hear a little bit on that point.
Yes, thank you. So we started off with family offices and multifamily office investors who were acquainted with the commodity trade, so they kind of knew what we were doing mechanically, and we're interested to both support SMEs and also have access to the sort of trade finance asset class, in the broadest sense. And so that was sort of phase one. And I think, going forward, we're now trying to really engage with the banking community much more because in end of February this year, we were able to receive a BBB+ rating for our senior notes program. So with our fund, our risk mechanics, our track records, we can now potentially create a very, very nice, pleasantly circular experience, I think is what the marketing gurus call it, where banks can give us SMEs they want to develop, but can't cost effectively support at the moment. We can actually process that through our risk engine and risk mechanics, very much like a clearinghouse, but for physical commodities is an easy way to put it. And then spit out at the other end BBB+ senior notes, which banks can then very effectively and easily support and invest in. And that money comes back to our fund, and then we do more trades. So, that's the phase two, where we hope we can actually really be that kind of buffer and that bridge to kind of unlock the liquidity that's kind of trapped in the banking system at the moment.
Brilliant. And just in terms of, a cap in terms of how far you can go, how fast you can grow, what are the main inhibitors? Is it simply a case of time and resources and building out, or are there other inhibitors that potentially might be at play?
Well, I think, obviously digitization and adoption is one thing. I guess we're in a privileged position where, being a principal, we can kind of say, okay, this is the process and you need to do it this way. So, it's not so easy for banks and other lenders to promote these types of measures. But I think COVID has been a terrible, stressful time for economies and people, but the one thing out of it, at least, is that there's been a lot of inertia built up over digitization, over standards. A lot of countries now adopting digital laws so that digital contracts or bills of lading or other documentation is as good as something written on a piece of paper. So there's been, I think, quite a lot of progress. I think things will get much easier on the digitization front over the next few years.
Fantastic. Very, very glad to hear that as well. There's a question here which is perfect for both Todd, and first I'll come to you, Oswald, which is around the education piece for SMEs. And I think you've both alluded to it in different ways. I think when you mentioned that even before you get to the point of financing, there are other issues that SMEs might encounter. So maybe, Oswald, if I can start with you, you can give us a bit of an indication as to how you think institutions such as the ICC are able to, and kind of aiming to, combat this knowledge gap that perhaps exists between the help available to SMEs and maybe the help that they think is available to them.
I'll briefly mention two. I think the first one is through initiatives like we're doing with our centers of entrepreneurship, where at least within different countries, they know, okay, this is where I can go to learn how to create a business, et cetera, et cetera, et cetera. Because fundamentally, that's what's required. Sometimes a physical location where SMEs can go, not in the digital world, but in the physical world, and actually gain access to that is required. And there's a lot of detail that I can give there. But I think the second one, which is very important too, and I spend a lot of time talking to different governments, and the reality is when you look at governmental processes and countries where governments are still mostly using physical pieces of paper for all of the processes that they have, the SMEs are still also mostly using physical pieces of paper. And so there's a place governments can play by taking some of the foundational services, digitizing that, and helping the local community get used to the digitization and processes that are digital. It helps them feel more comfortable going the digitization route. And in addition to that, it builds some of the foundational capabilities that we need for them to get to the actual, the utilization of some of these services.
Fantastic, thank you. And Todd, from your perspective?
Yeah, so I would agree with what Oswald said. When I think about the SME picture overall, there's really kind of 3 C's that would help solve their barriers. One is connectivity, one is capital, and the other is clarity. And so when you ask about education, I think it goes to that point of clarity, which is understanding what's available to them by way of financing programs, understand what's expected of them when they go to an organization looking for capital or financing. I think we as an industry association have an opportunity to promote standards more readily and across the SME community. Certainly, I think we, BAFT, can do a better job of that. But I think governments can do a better job of that as well. And that perhaps will help simplify some of the process that they need to go through with banks. I do think that there is also a need to really understand the risks associated with an SME trying to grow their business in the competitive environment. So engaging with the trading community is one of the other ways that we can try to solve that education.
Brilliant. Thank you very much, Todd. Unfortunately, we are into our final few minutes, and I want to give everybody a chance to answer the closing question because I think it's an important one that looks out. Perhaps I will begin with you, Todd. But I just want to ask, in terms of looking at the pandemic and the measures that we've seen, as you mentioned before, things like a furlough program in the UK or in Europe, or pay protection as it's referred to in the US, these are very likely temporary measures. But what, in your opinion, will be permanent measures that outlast the pandemic, even as the health crisis recedes? And what would you like to be the more permanent measures that remain in place?
So from my perspective, I think it's the behavioral change that individuals and companies will have gone through this pandemic, whether it's how they manage risk, certainly the extent to which they have digitized their business to create better connectivity with clients, with their trading counterparts and suppliers, and how they're approaching the engagement of their people. So, digitization, once you do it, you don't go backwards. I think that's going to be permanent, but it's also the behavioral lessons that they've had to learn.
Thank you. And Oswald, that must be music to your ears in terms of digitization and yeah, hopefully not going backwards on that front.
Yeah, exactly. I would just briefly mention three things. I think firstly, our businesses globally are more resilient today than they were before the pandemic. They all had to enact their business continuity plans, and as a part of that, embrace technology. I hope we don't see them, and even if that's just using simple technologies like Teams, for example, to collaborate, every step is a good step from a productivity perspective. And the second one that I really hope that we see a continuation of organizations like ours, WTO, BAFT, all of us working together to say, how do we help digitize trade and supply chains? How do we actually do it this time? It's been 22 years. Let's get the standards out there. Let's ensure that people can actually use that and democratize trade financing when it comes to adoption of digital. And the final thing that I really hope that we keep is the momentum, to Tom's point, at a governmental level. There's only so much businesses can do. We need legal reforms to ensure that a SME, a small carrier who wants to discharge cargo using an electronic bill of lading, can do so without worrying. And so that's where model laws like the Model Law for Electronic Transferable Records from the UN comes in and getting countries to adopt it. So I hope we continue to see the energy behind that.
Fantastic. And the final kind of brief word to you, Tom.
Yeah, I think the last couple of weeks actually been having some very interesting conversations around what we hope in the trade finance industry and trade industry going forward. And I think we've been over the last few years with blockchain and developments in this area, a lot of focus on disintermediation of the old processes and firms in those processes. But I think actually this is not really the answer here. Collaboration. So if there's anything I'd like to say over the next few years is much more collaboration rather than disintermediation, particularly avoiding IT islands where people are building stuff for themselves and their own little communities, and that's also causing a bit of a problem. The digitization is great, but we also want connectivity, and that's also where standards are going to be so important, going back to everyone's points.
Fantastic. Thank you very, very much, Tom. And indeed, thank you, Tom, Todd, and Oswald for this fascinating session. Really enjoyed it. I trust the audience did as well. So thank you all very much for tuning in. And now I'm delighted to move on to our next session, a little bit of networking. So put your cameras on, get your microphones ready, and get ready for networking roulette, where I look forward to meeting a couple more of you virtually as well. Thank you all very much.
Thank you.
Thank you.